Chris Ailman, founder and CEO of Ailman Advisers, joins us now. Hey, Chris, it's great to see you.
Good to see you.
New role, new job, new gig, your own thing. It's great to have you.
Thank you. It's wonderful to be here again. I really appreciate it.
So what do you think is going to happen for 2025? Do we have these fundamental drivers that are actually going to keep building on momentum, or are we going to halt?
The fourth year of a president's term, no wonder the economy is strong. The big mistake was it's strong too late. And what surprised me is, look at this year. The market is up 28%, one of the biggest bull markets. So reading Bloomberg on Monday had a great article about the fact that the number of new highs this year, historically, that does not repeat the second year. A market up 28% in 1 year does not usually repeat. So I'm done predicting markets. I'm retired now. But hey, I have to say the market on odds would be have a tougher year next year. And if you're a non-U.S. investor, you hit right on it. Outside the USA, when you invest globally now, the U.S. is 2/3 of the world market.
Right.
So you're concentrated in the U.S. And in the U.S., you're concentrated in these tech names. And that's a real problem for global investors. How do they diversify? They like small caps, but you can't move away from them. If a value investor is even finding value in these large cap names, well, come on, it's because they're up so big. You have to own them, otherwise you underperform.
Right.
Challenging year, and there are a lot of risks on the horizon.
Right, and also if you want to go to value, are you going to Europe? I mean, Europe has a whole host of problems. We just saw French government falling, right? I mean, maybe the UK is a stable place.
No, emerging markets. Emerging markets, they're cheap. Wait, they were cheap last year, the year before, the year before,
and look
the
at
year
South
before.
Korea.
And look at South Korea. Geopolitical risk, you've got two major wars. The Fed probably is stopping after this. Another quarter, they've lowered rates 1%. Bonds still have an option, and I think people don't rebalance their portfolio enough. Right now, this time of the year is a great time to look back. People are way overweight tech, way overweight stocks, and we've learned a lesson. Things don't run to the moon. They average up over time.
I am curious, though. I mean, on the terms of the portfolio allocation, and you talk about the overweights in stocks, obviously still crowded, but also we keep talking about all this cash on the sidelines, which is, I don't know where these sidelines are, but the cash is there apparently, and it's not moving. And,
it's all mine.
And you don't, well.
Lucky that guy.
Yeah, well, look, you don't need to move it, do you? I mean, like if you're getting 4.5%, and I know that's 4.5 isn't 28% or whatever we have in the equity market, but yeah, as you know, it's all relative. It's based on, you know, your risk levels and things like that. And there are a lot of people, they just want slow and steady returns that they can count on that outpace inflation.
Hey, slow and steady is the rabbit wins the race. We already know the story. You don't have to be, I'm sorry, the turtle. The rabbit, rabbit doesn't win.
Tortoise wins.
Don't chase short-term returns. Go for long-term returns. A steady return of 5 to 7%, your money is going to compound in a decade, and that's awesome. But with 28%, people want to chase with Bitcoin at these kind of levels. People want to chase crazy returns, and they will continue to do short-term, and I think that's going to hurt them in the long term. You want to be a nice, balanced portfolio.
But on the issue, though, of whether this rally, the stock rally, continues in 2025, there's been a lot of people also pointing out that first-year administrations typically, you don't, new administrations, you typically see softness in the equity market. But there seems to be a certain euphoria around Trump's election, primarily because most people seem to think there will be a deregulatory atmosphere, certainly not the regulatory atmosphere that we had under Biden. And more importantly, the idea that he's actually going to be a champion for certain things like crypto and Bitcoin. Do you buy into that? I mean, we got a new SEC chair. I mean, he's not there yet, but we know who it's going to be. Most people, the market seem to be reacting favorably to that.
I think the market reaction is investing in the rearview mirror. They look at the past 4 years he had, and it was a bull market. Different market coming into that environment in 16 and different economy. The Fed was at zero and barely raising rates after the great financial crisis. So I think really now you've really got to take a look at that first year term. There's going to be a lot of changes. Things aren't the same. He's going to care about the stock market. So I doubt we're going to have a traditional bear market, as we would call it. But I would expect after a market to run out of gas. Tech is going to do well, but you've got to diversify. You can't just be in these names.
But with his cabinet picks, or at least the ones that are economically and financially focused, and other advisors in that space,
with experience in their area.
I mean, do you have confidence that they will be good, at least be good stewards of the economy and markets in a way that might sort of extend this rally?
Yes, because the president, as last time, measured his success by the stock market more than any other past president. He quoted it. So I think there's generally, and I think the systems are going to be good. The systems are still in place. Unless this Doge group wipes out parts of government, and who knows what's going to happen there. But you know, I said last year, any president that won was going to be facing a huge budget crisis in that the interest on the national debt is eating up a third of the budget, more than defense. They're not going to be able to balance it. They're going to grow the deficit again. But you've got, you know, people in his party who don't want to do that. So I don't necessarily think it's just going to be a cakewalk. And I think we're going to see some challenges for them in the implementation phase. And we're already hearing from CEOs what they don't like is the regulation whiplash, on, off, on, off. They'd rather just give me a consistency to 5 to 6 years so I can manage into that.
Is the new 60-40, 60-40?
I think that, honestly, no. I look at my mother-in-law, and I can't talk Betty out of 90% stocks. And I look at my son-in-law, who is in his 20s, who doesn't want to be 90% in stocks. So I still think 70-30 makes sense, 80-20. But right now in America, there is cash on the sideline, but people are 80 to 90% invested in this market and in the large cap tech names. You were talking earlier about cap-weighted indices. Yeah. I love indices, but the problem with the MSCI and the Russell Index, you own the winners and you're underweight the losers. Warren Buffett would say, do that backwards.
All right, Chris, great to see you. It's been too long. Chris Ailman, who is now the founder and CEO of Ailman Advisers. Great perspectives here on the future of these markets.